Good evening, everyone. Thank you very much for joining us tonight on a session called Demystifying Angel Investing and its Role in Long-Term Wealth Generation. Today, we'll feature our friends and partners at AngelCentral as we try to debunk and demystify this very interesting topic. Very quick introduction. My name is Lawrence. I'm heading up partnership in Syfe, and I'll be your host today. I'll be accompanied by my colleague Hayden as we try to unravel the interesting role of angel investing or startup investing. A topic that's very close to my heart as a budding angel investor myself, trying to learn the ropes and also learn from our speaker today, Shao-Ning, how to do this better. Good. So for today, we have a pretty packed agenda, and so we'll go through it a little bit, and I'll delve into it straight away. We'll start setting a bit of a baseline and understanding the dynamics between the public market investing and private market investing, and what some of the considerations to look out for as you look into this alternative asset class. We'll follow then with what is angel investing and who is it for, and that will be delivered by Shao-Ning from AngelCentral. We'll have a fireside chat where we're trying to kind of discuss and talk about the recent topics, and we'll also welcome any of the questions you may raise throughout the session. And then we'll close the session with a quick introduction about Syfe and any remaining questions and answers. Yeah, and so we're really trying to understand angel investing a little bit better today, both from a financial point of view, but also from a non-monetary point of view. So let's get into it. So just setting a little bit of, I guess, a baseline context, given perhaps the different kinds of people joining us today, and really trying to distill what is angel investing, where does it sit in the bigger umbrella of investing, right? So naturally it sits in the part of the private markets segment, and it's a subset of that, talk next to venture capital, hedge funds, and private debt. And it really is quite a niche, it's a niche part of the world, but seemingly to be growing bigger and bigger. And at the risk of oversimplifying public and private markets, right, there's a quick overview here on this slide, kind of showing the different traits of these different markets, how they operate quite differently. Anything from obviously private markets being less scrutinized from a regulatory point of view, and therefore the information we can get on private markets is much more a challenge than it would be with public markets. This is a bit of a rule of thumb, and there's many exceptions to it, but company sizes, a lot of the companies in the private market space tend to be on average a bit smaller, small to medium, with the public markets considerably larger. Yes, there are obviously exceptions to this rule. And maybe very interesting, and part of today's session is about investor base. Traditionally, angel investing or startup investing has been largely institutional and a few very high net worth individuals, whereas public markets have been more for institutional plus retail investors. So what does it really mean, right? I think if you look at this, you'll see that public markets are generally very efficient. There's a better price discovery and low cost of transactions. But because of that and the information being so readily available, you'll see on the private markets that the earnings typically could be, higher. Yeah. What do we see across the world and globally, right? There's a growing allocation towards alternative assets. This is a 20-year snapshot in the US, where you see the US pension funds as well as endowments have allocated more in the last 20 years towards this asset class. And it was started by some of the large endowment funds, in fact, by David Swensen of Yale, that started this, leading the charge 2 decades ago. We've also more recently seen more retail investors allocate towards this segment, being an angel investing or venture capital. And there's probably 2 really chief reasons for this, right? The first one is there is a return premium, possibly for this, right? Because of the liquidity premium, complexity premium of something like this, where again, it's a bit less transparent and harder to understand, and therefore there is a premium for that risk you're taking. And secondly, and I think it's a very interesting point as we look at long-term wealth generation generally, is alternative assets can also improve the profile of investors' portfolio, as they typically have a very low correlation with other assets in a portfolio. And so in short, it helps with the diversification benefits. And to kind of underline this a little bit, here is a tab you'll see here of a venture capital on the top row. And you'll see here there's a negative correlation. So if you look at the top row there, a negative correlation with some of the large cap equities as well as the high yield bonds and fixed incomes. And so this is some data over a 25-year time period in the US. But it means a few things. I think one, it shows that the returns on venture capital typically do not move in the same direction as the returns of public equities and bonds, right? And so some of that can attribute it to things like the lack of daily pricing in venture capital. Now, if you look specifically a little bit more as a next step in terms of angel investing, and here's a very quite interesting graph that outlines on one axis the angel seed portfolio, and on the other side the NASDAQ index. You can see whilst there's a bit of a cluster, there's no clear trend line, right? There's no clear correlation. If there was, it would be a quite nice, a trend line cutting across the dots, right? And that's not the case. So it's quite an I guess interesting way of looking at investing into angel asset classes. Cool. Bring it a bit closer more to, I guess, the world of startup and investing. And a lot of people, I feel, and maybe we'll chat about this later, get a bit confused with the so-called alphabet soup of angel investing, right? Series A, B. So trying to maybe debunk a few or bring up a few. And one of them that we can't, I guess, avoid is the term unicorn. So yes, it's a mystical creature that is rarely seen. The same applies, I guess, for startups, right? And specifically, it's a label that people use for privately held companies that has a valuation that exceeds $1 billion US dollars, right? And quite interesting, as of last year, there were about 750 of them, and it seemed to be growing, obviously. And what is interesting too is to see the time to get to that status of a unicorn, right? So traditionally has been about 6 to 10 years. And if you look at Singapore, we're kind of close to 7 years in terms of that, the time for it to take. And I think it's also important to note that out of the many startups, very few would actually, reach the status. Yet, from an investment point of view, it may still be very good investments, right? But something to continue later at the conversation. I also want to bring this conversation a little bit closer to Singapore and I guess Southeast Asia. And so this chart you'll see here, this graph, I should say, is really about the newly minted unicorns in the recent, I guess, last 8 to 9 years, right? And if I click here, you'll see some very familiar names, but you'll see an acceleration. You see this ecosystem really evolving, and some of the exits already happening, right, with more recent IPOs and SPAC. And so, if you look at last year, 2021, there were these more than 90 unicorns being minted in this part of the world, this region of Southeast Asia. So that leads us to, I guess, the poll that I'd like to ask you guys to participate in. If you can launch the poll now, is to ask you a little bit about your own, I guess, interest and experience in the world of angel investing. And this will be the kind of the final section before we go into handing it over to Shao-Ning to talk about this. So the question is really, the poll is, have you invested in startups? Yes and no, and maybe also why yes or why no. Very keen to hear your thoughts, and it may also help us a little bit with the next session, where we'll be able to kind of maybe tailor a little bit of the content according to, I guess, your experience levels. We'll give it a few, maybe 10, 15 seconds for these answers to come in. So feel free to use Zoom to submit your answers. Very keen to hear them. All right, so let's see. We have received, I guess, if I collectively add, a pretty overwhelming no. So if I do a quick math, I think more than 3/4, close to 80% has never invested into this, but seemingly there's an interest to do so. And some of you guys have already directly invested in startup, and some a smaller group into, I guess, VCs. Very interesting. Somewhat, I guess, expected this result. So the next poll that I have is a bit of a continuation of this. What has been preventing you perhaps from investing, right, into this, I guess, niche asset class? Why have you, and you should obviously read as what is the key reason for preventing you from investing in angel investing. So really is around angel investing specifically, and very keen to hear, I guess, your thoughts. And we will see if in the next part, Shao-Ning is able to confirm, debunk, or at least demystify whether some of these, I guess, concerns or considerations are valid or not. Yeah. I've seen one question right coming in from the group that people are asking, how do they have even access to this, right? So let's see. So out of all the, I guess, answers we've received so far, leading is, I'm not sure if I have enough funds to invest, right? So it's a big question about what is generally the ticket size required for these investment opportunities. Second, followed by, I guess, I'm not super familiar, right, in this asset class, and how do I go about this, perhaps? Okay, very good. Thank you very much for your contributions. I think one more thing, and I'll keep quiet for now, is I'd love to introduce a fellow presenter for today, Shao-Ning, who is obviously the chief angel and a co-founder of AngelCentral, which is a very prominent community in Singapore in the region of about 140 over angel investors who've collectively reviewed more than 2,500 startups since 2017, and have also invested in over 70 of them. On a personal note, I know Shao-Ning is very active in the startup community, is helping a lot of startup founders and trying to kind of breed and grow the next generation of founders and those the existing generation as well. And I think one of the interesting things about her is that she brings a very interesting perspective around angel investing, having been an operator herself, right? So she's been a founder with a life partner and other people, AngelCentral, some of you may know this from probably the previous decade, and really kind of seen it from, I know it shows your age a little bit, Shao-Ning, I won't disclose that, but I guess you really seen it from starting a business, growing it in Singapore, in a region which was not as, I guess, accepting of startups, all the way to an exit, right? And now kind of paying her dues and helping that. And lastly, she has, I guess, 4 startups at home, and I'm referring to your 4 sons, which I guess by now may be actually more of a scale than a startup, and hopefully they graduate and exit themselves soon. But yeah, very, very pleased to have you here, Shao-Ning, and I'll hand it over to you. Yeah.
Thanks, Lawrence. You basically just counted backward and show that I'm almost in my 50s now.
Okay.
I
would never dare to do so, but yes.
Okay, thank you for the really nice introduction. If I could just share screen now. So I will spend the next 15 to 20 minutes trying my best to demystify angel investment. So it's quite a text-heavy slide, so I will not go through every single point. So just feel free to take screenshots or take photo of the slides if you think that's necessary. Okay, just very quickly, this is what I'm going to cover today. And since Lawrence has really done a very good introduction of me, I will not go further in that, but I'll just touch on very quickly. Right now, for me personally, after I exited from AngelCentral, I started AngelCentral I exited in 2012, bumbled around for a few years trying to figure out where my life is going for the next second half of my life. And then I came into AngelCentral because I see the opportunity, I see the gap in the market, and I really feel that one way that I can really pay it forward to support the ecosystem is to really bridge the early stage investors with the founders a lot better. So that's my goal for the second half of the year. I'm giving myself up to 50 to do it. Okay. So just now, actually, I took a quick look in the Q&A. I only saw the first 2-3 questions. If I don't answer this, I will actually go into it, but I think some of the answers will actually be addressed in the slides that I'm going to go through. But just a quick warning, as in investment, I think it's financial literacy is something that I think we all pick up along the way. Unfortunately, the schools that we went to didn't really focus on financial literacy. So it's something that personally, I really feel that it's very important. It's not finance 101 per se that we're talking about. We're talking about real life, how you deal with money. It's money sense. And so today, what I'm sharing is really more of a consolidation of my personal experience after I exited and how you should adapt to actually apply your own framework. But generally, the framework is what my husband and me found very useful, and it's what we are, in a sense, teaching in the master classes in AngelCentral. Okay, so what is angel investing? I think we all know, we don't need to go through the details. Basically, it's investing in a very early stage company, typically in the first 36 months of the company's life. So what does that mean? It means it could be idea stage, it could be just some execution, it could be some early traces of revenue. But what we need to bear in mind is it's actually investing in, I don't want to say it's betting, but you have to evaluate based on what you're able to get. And a lot of the what you need to do for your due diligence, your homework, actually have to be both on the company itself, on the founder itself, and on the market itself. So it's very different from the open market investment. When you're talking about your late stage or even in a listed stock, there's a lot of finances for you to go through. But for early stage, you're actually you don't have much numbers to back on. The 2 key features of early stage investing I want to highlight is, I think Lawrence actually touched on the table just now. They're highly illiquid, and they're highly binary. Binary means, I think all the physics students will know, 0 or 1. In the first 12 months, you will know whether this investment is going to be 0, meaning you got to write off every cent that you put in, or it's going to be 1, meaning you have a chance of getting your money back. And if you refer to the US data, there's not much data for Southeast Asia, unfortunately, but if you refer to the US data, in the first 3 years, 70% of the companies do not work out. So when you're doing such early stage investment, first of all, what this means is you have to have patient capital. And all the more, in order to manage the risk of such early stage investment, is you must have a portfolio of angel investment. You do not just tikam or hamdam, I like this founder, and this year I do this case. And then you put all your allocated budget into one company. Unless you have a crystal ball, unless you have somebody back from the future to tell you to invest in Yahoo, you do not bet on one company. You should have a portfolio of, later I'll go into it, but you should have a portfolio of at least 20 to 25 companies over a period of 4 to 5 years. Okay, so why do people angel invest? So the motivation are 2 categories. One is financial, of course. The other one is non-financial. So financial is actually it's a very straightforward thinking. It's a diversification from your asset classes. I think Lawrence just now shared with already. Venture capital and early stage private equity investment, there's not much correlation to your usual market movement. But it's something that I think later when you go into the portfolio allocation, you will see that actually I do not recommend I would not recommend anybody to put the bulk of your investable asset into early stage investment because of the fact that it's binary and highly liquid. Okay, financially, this is an asset class that gives you multiples of returns versus your other asset classes. Usually you aim for 6 to 8%. Even, and let's say for your bonds or for your REITs, 2, 3, 4, 5% is what you are looking for per annum. But for angels, what we need from the portfolio is 3x for your multiples, for you to be worthy to take the kind of risk. Of course, some of the angels who are thinking of moonshot, for me personally, I'm more a decacorn or multiple, more than 200 million kind of exit kind of target. So unicorn, like what Lawrence was mentioning, in the past, it was quite elusive. Nowadays, there are so many. And because of spec, now the unicorns are like 3x, 4x of the what per unicorn, right? So it's, in a sense, it's also a market situation. While it's a different conversation, but personally, I feel that because of the spec phenomenon, some of the valuation actually was a little bit too published. So the second category of reasons why people invest is actually because it gives them, first of all, the experience of being a founder together or along the side of founder. So you're like a surrogate founder. So like for me, I was a founder for 14 years. I don't really miss it. I don't really want to go through it again, but I definitely miss the up and down. But I don't really want to go through the day-to-day. So when I invest in a startup, I actually live through the startup to go through that. And for me personally, definitely it's a way for me to pay it forward. When I work with the founders, sharing knowledge, sharing my experiences with them to see how to deal with different situations, it's a way for me to help them as well. So it's really, and also at the same time, learning on new areas. For my background, I'm comfortable with marketplaces. I'm comfortable with e-commerce, SaaS, and B2B. But in order to diversify, I have to go beyond this group. So I went into healthcare devices. I went into some biotech. I went into prop tech. But the fact is, I had no idea what these are. But of course, before I invest in, I had to study a lot of that. So it's actually a way for me to keep on learning. But of course, you don't invest for the sake of learning. But in that process of investing, before you decide whether you're learning, you're going to invest, there's actually a lot of learning. So you must enjoy the learning. And the learning is not purely on your own. So like within AngelCentral, about 130 of us, we actually run a deep dive, and a lot of them actually leverage off each other. So your learning is actually off from each other. Okay, so coming to the topic of portfolio, again, reminder, highly illiquid, binary, which means it's very risky. So the money that you're putting into this asset category, ideally is something that you do not need to touch for at least 5 to 7 years. So 2 ways of thinking about portfolio. For those of you who work with the private banks, you will know that private bank will always talk about, you have a portfolio and then how much you should allocate for the different asset classes. So that's one way of thinking about it. The other way of thinking about it is using the buckets. Some people use the dumbbell theory. So one, they will go very high risk, one, they go very low risk. But for me, I actually think that a bucket view is actually, it will take care of your current cash flow needs as well. For the short-term living, you will have a bucket for, the three buckets do not need to be the same size. So it really depends on your personal situation, right? So angel investing, early stage investment definitely should come from your legacy bucket, because legacy bucket is the one that you should be putting aside for, that you do not need to touch for long term. And that's also the one that you can take higher risk to get your long-term returns. So personally, between my husband and me, our early stage investment is between 7 to 9%. So we are higher than usual, but I don't recommend to be more than 5% of your investable amount. So within your investable amount that you're allocating for high early stage, further diversify into a portfolio, either includes a PE VC style, or purely a portfolio of angels. So again, it really depends on your own situation. But you got to bear in mind that angel has an entry point, smaller check sizes. VCs typically minimum at least $500,000 for your commitment. So if you're not familiar with the VC business model, we have an article on AngelCentral that is talking about between angel investing and VC investing. But that article is written from the point of founders to help them understand the business model difference. But it will be a good starting point to understand what this tool is about. Okay. Then within the portfolio itself, how we recommend that you further diversify is, let's say your overall number is the blue ball on top. Let's say we take 10% of that. Okay, for easy mathematics, that 10% is the amount of money that you need. Then you further break into what per investment size should be about. So from there, you will realize that what is the bite size that you should have. So using an investment case of 20, so you use 200,000 divided 20, what is the minimum check size that you should have? Then out of this 200,000, do you want to further allocate for follow on? Because when the startups are coming to you for the first round, so just now actually Lawrence also touched on this part, the alphabet raise of funding, right? From angel, seed, A, sometimes they are pre-A, bridge A, and then A, then B, then C and D. So you got to know that how much you are going to allocate per company within the portfolio, and then for your own allocation, your own thesis, do you intend to follow on? Follow on means, let's say you go in at angel level. Let's say you put in your first 20,000. After that, do you intend to follow when the company does well? Philosophically, it's something that you got to decide for yourself. So your US data will tell you that actually there's no difference between whether you do follow on or not. But for me personally, there's a big difference, because psychologically, if I need to write off 20,000 versus I need to write off 50,000, is a very different story. Okay, so for me personally, between Dashing and me, our understanding is per investment, our budget is 200,000, but we will never put in the total 200,000 into the startup in one go. So if it's an early stage company, based on valuation, if let's say it's under 5 mil, we will actually put in 50,000 first, then we allocate 150 for subsequent rounds if the company is doing well. But if they're not doing well, of course, you're not going to put good money after bad money, right? So it's on a case by case thesis that you have to think about. So expected returns, I mean, this one I kind of like let the cat out of the bag when I was mentioning it just now. So for the usual asset classes, these are the kind of percentage returns, the IRRs that you're looking for. But angel investing, typically we are looking for at least 10 to 15% for the worst case. And this using the US VC model. So VC actually, very quickly, for those who are not familiar, VC model is a 220 model. So for every $100 you put in, they will take $2 off your $100 for management fee. So for a commitment of 10 years, they will actually take out almost 2 times, at least 5 to 6 years of the investment for the management fee. So net of fee, using US data, or US early VC data to give a sense, it's actually at least returning net to LP of 15 to 16%. So for an angel, there is actually no fee involved. You have to beat at least this kind of number. Okay, so in long term, again, it's using US average data. This is actually data from 2020 2020, you need to at least be able to get back a 20 to 23% return to get your decent IRR to be worth the risk. And in ASEAN, yes, we're having more unicorns, we're having more exits now. But I think for those who are tracking, SPAC is kind of like on shaky foundation right now. Our two biggest SPAC from Southeast Asia, y'all know where the direction of the share price was for the past few weeks. So it's internally, sometimes we are wondering aloud whether SPAC is going to be a consistent phenomenon going forward, or is it going back into RTO picture? That seems to be more likely. Okay, and so Southeast Asia trade sale is still more a likely exit. Trade sale meaning the startup will be acquired by a company that is much bigger in size, which could be a traditional player or a company in a later stage in the same space. And that will typically, the acquisition valuation, I think a good case, 200 to 400 million. That is actually still a very good return. Okay, so somebody asked about how to evaluate a startup, whether it's a gut feel. Definitely, we hope that it's not a gut feel. If you like gambling, I recommend the casino. At least you know the result within the next 10 minutes, but you don't play with money this way. So angel investing is not a gut feel. It's actually a lot of homework behind the scene. Okay, so this is actually, I'm supposed to talk about deal flow, but I think deal flow, you guys can figure out on your own. This is actually the framework that we teach in the AngelCentral Master class 101. So just to bear in mind, we would expect an angel investor to be financially comfortable, meaning financially literacy comfortable, meaning you know what IRR is and all this. But evaluation is a very different ball game from evaluating your REITs, evaluating your shares or bonds. Okay, so these actually are the 4 factors that we consider. The most important thing that we look at actually is the founder. So the reason why the founder is so important to us is you have to bear in mind, early stage company, a lot of times they started off because of an idea or because of a problem that this person or this team of founders experience and believe that they can do something to solve it. So how they bring the idea into fruitful situation, how they execute it is actually what we are looking for. But then again, looking at the context of opportunity, if that problem is only relevant for you or that group of founders, meaning it's not big enough, it's not relevant for a lot of people, then it's a problem that it's not going to be big enough. So put it this way, a lot of times I ask the founders, if you start up this business, who will be your customers? If only your mom and your relatives are going to buy from you, then it's not good enough. Okay, so for angel investing, especially for AngelCentral, what we are looking for is scalable businesses. We are not saying that, so some founders will feel that, oh, if the VCs or the tech investors are not investing in me, am I a doomed business? Definitely not. But however, if the business model doesn't have the opportunity, the market size to support the scalability of the business, that's why we're talking about the hockey stick. It will not be a business that can give us the 20 to 25 or even 30x of return. And that's why it's not going to fall into our investment thesis. It doesn't mean that your business is not good, but it just means that it cannot, it is from our own modeling, we do not see it being able to meet the scale growth that we need to get the kind of multiples for the investors' return. Then of course, we look at the deal size. I mean, the deal terms on offer. If you are based on the idea, you're asking me for 25 million valuation, then I say, so Serena, my staff always laugh. I will say that this founder is from Mars. They're not from planet Earth, because the way they're expecting things to work is just not realistic. Then again, valuation is something that that we actually have one chart. You can see that valuation from early 2010 to now actually has grown almost 40 to 50%. So for a same type of company that has, let's say, it come out to raise money in 2011 versus now in 2020, 21 to 22, for the same business, same stage of growth, you will see the valuation, there's a huge spike. So again, I think that is more like a bubble effect in the economy that we can see. And if you're Another thing that we are looking at for deal term is sometimes you will see investors saying that we want to find companies from regional countries rather than looking at stories from Singapore. Because right now within Southeast Asia, Singapore company actually commands the highest valuation. So imagine you want to put in $100,000 into a company that is $3 million valuation versus a $5 million valuation. There's a huge difference. Okay, I'm supposed to provide a lot more details here. On the founders, there are actually a lot of things that we are looking at. You will hear some VCs that actually have a checklist of what they do not invest in. And one of the key consideration for quite a few VCs is they do not invest in single founders. Personally, I don't think that I don't work that way, but I understand why certain VCs will view that way and certain investors will feel that way, because imagine the amount of issues you got to go through. So give it a very simple example. Let's say I'm a business background person. I can handle the business side of it. I can handle the customer service side of it. I can handle the accounting, finance, marketing side of it. But when it comes to product, I will be totally handicapped, right? So if you have one founder who got to deal with everything, imagine whenever there's issue, the founder will be talking to him or herself. You're always just talking to the person in the mirror. It's actually very, very stressful. So typically investors want to go for founders that are in pairs of two or three, because that means that the skill set is more spread out. There actually could be more support when it comes to issues and different functions. But then again, we also have to remember one of the top 3% of why founders break up is actually the reason of one of the top 3 reasons why startups do not succeed. So it's actually a catch-22 situation. So a lot of investors do not want to invest in solo founders, but we also recognize that the inter-founder issues is actually one of the reasons that investors spend a lot of time supporting the founder to get through. And one thing, when we come to duty, we are quite particular of how founders actually compensate themselves. So some mid-career founder, they will say that I used to draw a salary of $12,000 to $15,000. When I come to the startup, I expect to draw that. So certain investors are okay with that, but investors like myself, I would not accept that, because you do not use investors' money to compensate for your lifestyle, right? So personally, that's my philosophy, but it's something that I think for me is actually quite a no-no. So it's something that you actually have to figure out when you do the due diligence. And that so actually based on all this, right, what we are really trying to find out is the caliber of the founder. Is this the group of founders that you believe can bring that dream, that vision to fruition in say 5 to 7 years? So that is what we spend a lot of time trying to figure out as early stage investors. Of course, we also look at who are the early stage investors. So you will hear of this word FOMO. There are some investors who say, oh, so-and-so is investing, we need to follow. And that kind of thing. I would just say that if there's always a next deal. So for us, we look at 800 deals a year. I believe there's always a next deal. So do not invest because of FOMO, okay? So in summary, the angel investing ecosystem, the startup ecosystem is definitely getting very exciting, but it is a high risk asset class. So you should invest both for financial returns and also because you are going to enjoy the ride. But again, remember, 70% of startups fail within the first 3 years. So you must be able to diversify. You must have the discipline to buy size so that you can manage them as a risk. And it should be money that you do not need for the short term. Okay. Okay, I think that's about all my presentation. I hope I kept to the 20 minutes. I didn't really track the time.
Thanks so much, Shao-Ning. I think, no, thank you very much for this and for taking us through this. I'll share my screen. Oh,
okay.
As we kind of progress now to the, if you don't mind just, I guess, disabling your screen share, and then I'll do it on my end. Thanks so much for that. I will just we'll proceed to the next phase, right? And it really is a bit of a chat between yourself, myself, and Hayden around this topic. And I think you've hit a lot of points, right? Evaluation a question that we've gotten, and I think it's a question that comes to the mind of many is, right, what is the profile of an angel investor? People think typically, it's this high net worth individual, right, that has plenty of money. People ask a question about ticket sizes, right? How much, do you need in order to even start that journey?
Okay, so for the matured early stage investment market, like in the US, you have heard of angels who start investing with $1,000 and $5,000. There is a technical difficulty with that. Okay, you can do that too in Southeast Asia, but you think from the startup's point of view, our Companies Act does not allow a private company to have more than 49 investors on the cap table. So if the startups start taking $1,000 investment check, if they fill out the whole cap table, 49 minus 2 founders, they can take 47 times 1,000. That's the maximum amount they will be able to take. It's just not practical for them. And that's why founders, for simplicity, actually really for pragmatic reason, they will always ask for the 50,000 to 100,000 minimum check investment. And working backwards using the diversification portfolio thinking, if you are going to invest, if you're going to follow the founder's thinking and then do 50,000 per investment at 4 investments a year over a period of 5 years, you need to have a net worth of at least $7 to $9 million, which unfortunately we are, per capita basis, we have the most number of millionaires in Singapore, but unfortunately the risk appetite is different too, right? So that's why we have to be, for AngelCentral, we came up with a way to syndicate investment. So we allow for investments that go through a syndicate structure, the minimum check size can be brought down to 20,000, but we will have a SPV, a special purpose vehicle to structure that to support the investment. So from the founder's point of view, they will have one entry on their cap table.
Understood. Very clear. Thanks for that clarification, because I think, good to see that some of the bite sizes could be allowed to be smaller, but obviously the downside from the investor point of view or from the founder point of view. Hayden, go ahead.
Right. I think that's a very interesting point. And I think a question that came in, and as an extension to that, Shao-Ning mentioned that there's a limited number of investors that can partake, 49, as she mentioned. So as an angel investor, do they have a part to play in the business? Maybe are there board seats, and or how active should these angel investors be when it comes to the business?
Again, I come from a more practical side of it, okay? So angel investors, working backwards using the percentage, let's say you invest in a company that's $5 million, 5 million valuation, and you put in, say, $50,000, that will put you at 1%. As you will know, in any company, you ideally at least should have at least 5 to 10% before you put your hand up to make some sound, right? Put it in a more polite way. So as an angel investor, actually, usually for me personally, my first round, I aim to be between 1.5 to 2%. But if I'm the lead of a syndicate, the syndicate will usually take up between 12 to 15% of the round. Part of the understanding that we will have with the startup, the syndicate lead will be on the board seat. Okay. I would say for investors who are going in alone, when you are at 1.5 to 2%, I would strongly recommend the angel investor to be a cheerleader, support the founders along the way. To be a board seat, I know sitting on a board seat to some people is a good resume booster. But I would also like to highlight the fact that if you're on the board seat as a director of the company, even though you're non-executive director, there are fiduciary duties involved. So it's not a pure ego.
With great power comes great responsibilities, Shao-Ning.
It comes with a whole bunch of responsibilities. And so personally, I have between Tertiary and me, we're about 42, 43 companies now. I only want to be on the board if I'm leading the syndicate to invest in it. I would actually prefer not to be on the board because it's a lot of work. Yeah.
And just as a clarification, maybe their Tertiary is a life partner and her business partner in AngelCentral, and they do a lot of these, deals together. So just for the benefit of the rest.
Yeah.
Okay. Sorry, Aiden, did you have a question?
No. Thank you for the response, Shao-Ning. Over to you, Lawrence.
Yeah, I guess, Shao-Ning, I had a question, right? And this is something that people talk about a lot, right? There's Property Guru, obviously went public last Friday, we had Grab, and we can make the arguments how they've performed, right? But one thing, and you've been in this industry for a long period of time, right? Without wanting to make you feel old. But how has it evolved and what's your view on this? Because there's talks about secondary exits, right? For early stage investors to come to exit even before the company exits, right? There's things about unicorn valuations that are coming up like left and right, right? So there's a lot of things happening. There's global VCs that are setting office here. I guess would love to hear your thoughts as you kind of look at the next crystal ball and look at the next 5 years or so where you think, you know, this could be and where angel investing sits.
I think it's definitely a very good way that the ecosystem is evolving, right? I mean, when I started my startup, there's no VCs in this part of the world. And then the government really put in a lot of effort with the NRF pairing and stuff like that. You start having a CVC setting up, and then from there, the CVC went to Series A, Series B, and now even the hedge funds are actually on the private sector, on the PE side is coming here. It's definitely a good place to be at. But I would say, like, I mean, we're just talking about it, specs, the way it's overvaluing when you kind of like, I mean, end of the day, you still got to go back to PE ratio. So in the past 6 months, you can see that, I mean, be it on the macro side, where there's a war and everything, you could see that actually the loss-making tech companies on SPY and QQQ are actually on the whole, it's a nose dip, and now it's coming back up. So overall, there's a bit of bubbly effect in my personal opinion. And I feel that it kind of like trickled into, even though there's supposed not to be a correlation, but it actually trickled to have a very direct impact on the specs willingness to take high valuation. So when the nosedive came, the specs actually overall is just negatively impacted. So for this part of the world, I mean, we all know the local exchanges just do not have the kind of liquidity that we need for our exits to happen. So they will still go to the bigger markets. So with the VCs setting up here, I think it's good news. But I think the trend is they will find the deals here, they will bring it over, but I think probably go into more traditional style IPO or even RTO. Yeah, but definitely it's a good thing. I think it's definitely a good way for us to support. And besides, actually, out of the 800 companies that we see a year, right, easily about 20% of the companies are actually Singapore domiciled, but Southeast Asia active operating businesses. So it's actually a very clear sign that we are the capital of Southeast Asia for capital raising. We are the hub. So it's a good thing for our economy, for Little Red Dot.
All right, thanks, Shao-Ning. And I think maybe just to also tap onto your experience and for the benefit of our viewers today, in your view, where do you think, are some opportunities that angel investors can be looking at right now? I know earlier we have seen most unicorns come from the States and also followed by in China. But do you think this is pivoting elsewhere, and where do you see, angel investors investing in the company?
You mean which sector or which geography?
Maybe geography and sectors too. I think the viewers would like to know your opinion on this as well.
Okay, so I wouldn't really think of geography as where I should go because which market is hot. Okay, I would say that actually angel investors, one thing that as in any investment, one thing I think Singapore-based investors are very lucky that we do not have capital gain tax. So if you want to go into the US market, even through AngelList, or you want to go into China, you need to understand the tax implications. So that's one thing. The other thing that personally, I believe that I would want to invest in geographies geographies or verticals that I'm comfortable with, that I can understand, is as an angel investor, one of the reasons why you go in early is part of supporting. So it depends on whether you want to be an active angel or you're on a passive angel. So if you intend to be a passive angel, after considering the tax, after considering the exposure, I think any space is fine. But for me personally, I think I probably can't help somebody who is from Middle Eastern. So I would be a totally useless investor from founders that's outside of Southeast Asia. So again, it's your philosophy of what you want out from angel investing. As for which sector is hot and good to go in now for the best valuation, I would say compared to the US startups, Singapore is still cheaper in terms of valuation expectation. Then again, regional countries are still cheaper. So just numbers. US companies for the same industry is always the most expensive, followed by Greater Asia. Then Singapore is maybe about 10% cheaper. Then the whole Southeast Asia, another further 5 to 8% cheaper.
Right. Thank you very much, Shao-Ning. Over back to you, Lawrence.
Yeah. Oh, thanks, Shao-Ning, for sharing there. I think the time is up. We'll try to have a few more Q&A towards the end, but I think given the time, we'll leave you for now a little bit, and we'll do this last section of today's webinar, which is around how Syfe comes in here, and also again the Q&A. So just kind of wrapping up in a little bit of the conversation we had earlier. So, and those who have tuned in or not familiar with Syfe, a very quick introduction. So Syfe is a MAS licensed digital investment platform. We're based out of Singapore, headquartered out of Singapore, and we aim to build and create high quality financial solutions. And we try to make those very affordable and accessible to all, right? And I think part of that is also understanding the wide spectrum of investing, like angel investing. But naturally what we do is to make it really accessible and affordable. A question we often get, and just want to maybe clarify that up front, is a question around safety as we handle with our clients' monies. And so there we are, and again, an MAS license holder, particularly one called Capital Market, the CMS Capital Market Services license, which comes with a very stringent set of requirements. One that is really important for our investors to know is that one condition of this requirement is that we have to segregate the assets of our clients away from our own company assets, which means that investors' cash and as well as the financial assets are held in a custody account with one of the banks, such as DBS or Sexo and its custodian banks like Citi and HSBC. So yeah, this is really important, and I think just to highlight the safety element of this is that in case something were to happen to Syfe in an unforeseen circumstance, investors still have access to their holdings and are able to redeem in full. As part of our mission to make investing accessible, we're trying to have a menu of offering or a suite of products, as you'll see in this slide, that is available to a lot of people regardless of what their investment goal is. And it's generally designed to be long-term and passive in nature, and it would suit people with different investment goals, different time horizons, and different risk tolerances. And I won't go into all the details of each individual portfolio. I think just to highlight one is the core portfolio, which is the most left bucket here on the screen. And it really is meant for long-term passive investing. And it's a globally diversified portfolio that is across asset classes. So you'll see it comprises of equities, bonds, and gold at different levels, depending on the risk tolerance, but it's also diversified across sectors and geographies, right? So really a passive strategy around seeking market returns, cost-effective in nature, and they obviously achieve diversification. In addition to this, and we'll get to that concept about core satellite investing, which is a really big part of Syfe's investment belief, are satellites, and we'll go into a bit more detail shortly. But these are smaller niche investing strategies where people can express their view. And so if you look at the screen, there's a number of different satellite investment strategies that allow people to take some, I guess, more specific exposures to sectors that they believe very strongly in, or putting the money where their belief system focuses on. This could range anything from a REITs plus portfolio we have with a high attractive dividend yield of close to 5%. But generally, again, coming back, it is focusing on a core satellite. And I want to spend a bit of time on this in the next few slides because it ties today's session about angel investing as well. So if you look at this slide, you'll see a majority of one's holdings, as Shao-Ning has also mentioned, is typically not necessarily in angel investing, right? It's typically more your core portfolio, which is often, and what we suggest, around a broad-based and indexing tracking equities or fixed income ETFs. But then on top of that, you can layer on some satellites and have some small allocation to asset classes that you may strongly believe or that are not necessarily correlated, right? So angel investing could be one of them. It could be things like crypto. Again, we like to believe that the allocation should be a minority and not the majority of your overall holdings. Within Syfe, we're structured around a very similar vein, right? So we have the core, which I just spoke about, but then we have different satellites that one can add on to express your respective investment philosophy, right? Whether it's something like a Syfe REIT Plus, the thematic investing you'll see here, such as popular themes such as ESG and clean energy, or build your own portfolio through our custom offering, or last, but certainly not least, our latest offering in town, which is Syfe Trade, which is a fractionalized neo brokerage offering. If all of this seems a little bit lot, we do have a very good team of advisors here, Hayden included, that can help you navigate through this great and wonderful world of investing if it isn't clear. So feel free to reach out to us afterwards. And also like to draw your attention to coming webinars. So next week we'll have a session on geopolitics and the climate turmoil. The week after we have a session around simple technical analysis for long-term stock investing. So feel free to join us in the coming weeks. As a big thank you, and you've stayed with us for the last 55 minutes or so. And if you're new to Syfe and want to start your journey, feel free to use this promo code you'll see on the screen called Syfe Webinar. That will entitle you for 6 months free investing with Syfe up to $50,000. So put it in the promo code. And as always, we're very keen to get your feedback around this session and what you'd like to see going forward in these webinars. We take it very seriously in trying to craft this according to your interest.
Right. Thank you very much, Shao-Ning. I think as we are a minute, or if not, we're at 8 now, I will leave the remaining few seconds to Lawrence for closing. Lawrence?
Yeah, no, thanks, Hayden. And a big thank you to Shao-Ning for sharing your pearls of wisdom, being both operator and angel investor. I think it was an insightful session for people to understand the dynamics, the inner workings, and how you evaluate. As we kind of review, right, obviously public market and private market investing is a very different way of thinking, going about this. That comes with different risk, right, and different liquidities. So not for everyone, and definitely not for the faint-hearted. But big thank you today for kind of sharing a little bit, because I think it is an area whereby whilst growing, it's still very small and it's still very niche. And so hopefully at some point we'll look back and you say, wow, this was back in 2022. We talked about this, and now everybody kind of knows what this alphabet soup is, and everybody knows that SPAC was real, here to stay, or was maybe a fad, who knows. But a big thank you, Shao-Ning, and for all the people who tuned in today. Thank you for joining us now at the end, and we look forward to seeing one of our next few sessions.
Thank you. Thanks for the 15.